Hey guys, welcome to a new video. In this video, we will be talking about OrderBlocks, one of ICT's concepts. Using OrderBlocks makes you more profitable on a chart. OrderBlocks is usually formed after an important level is taken, such as a liquidity level or the fair value gap. Often more effective on the higher time frame than the lower time frame. So let's hop into a chart and let me show you how to spot them. As you can see, every single one of these have in common is a big displacement below. And OrderBlocks can be found as consecutive candles of the same color or just a singular block. And how does this help us? Bullish trend or bearish trend? And for bullish trend, you will be looking for red blocks. And for bearish trend, you will be looking for green blocks. So how do we utilize this on a chart? And how could we be profitable using this? First, you will be going to the higher time frame. OrderBlocks is usually more effective after a important level is hit on the higher time frame. In this example, we will be looking for highs or lows being taken on the higher time frame. As you can see in this example, the high or the buy side liquidity level has been taken. The thing I would like to see is it displaces below the area of the liquidity, which shows a sign of it not willing to go higher. If this does not happen, you should not be looking for an entry, since the chart might be looking for the next liquidity level. Once it displaces and closes below the liquidity level, you will be going to the lower time frame to look for a setup. Here's the lower time frame of the example. As you can see, we need to displace below OrderBlocks. And we mark this out, and we could take an entry when the market hits it again. We could take an entry either here or when the market retraces back into the zone. And where do we target? We could target the next low, or we could target, if we go into here, we could target this low too. It depends on where your entry is. And where do you put your stops usually? When you go short in this position, you put your stops above the OrderBlocks and target the next low. Here is a very good entry to take. Or the next entry you could take is when the market retraces back into the zone. As you can see right here, you put the same stops above the OrderBlocks and target this low, previous low. And this is another good entry. So how effective are OrderBlocks? OrderBlocks are usually more effective when it's not reached into the 50% zone of the body of the OrderBlocks. So I will draw this out for you. And as you can see, we marked out the body of the candle with a fib. If the market closes above the 50%, you'll not be taking a trade. Let's look for another example on the chart. You could either go 30 minutes, 15 minutes, an hour, 45 minutes, 2 hours. Anything above 15 minutes will be more effective for looking for important levels. Here's another example of where we could take an entry. As you can see, the low being taken here traces back into the zone, and we will be dropping down to a lower time frame now to look for an entry. As you can see, the chart here is very choppy, but we could still find a setup here. Before the big displacement above this candle, this makes this an order block, and we could take an entry once we enter in the order blocks. It will be supporting price here. We can be taking an entry once the chart goes above this level, and it has to close above this level for it to be effective. As you can see in the market here, we do close above this candle, and as soon as it retraces back into the zone right here, we could take an entry, and we could go long here and put our stops below the candle. And where could we reach for? We could go to the higher time frame to look for any important levels that's going to impact us. You can see here we have a breaker block, what we will discuss in the next video, and we will take our entry, which you see the chart does go to, and take profit. Okay, let's go on to the next example. As you can see, I marked out the 50% here, and I'm going to show you an example of how it could be used when it goes into the fair value gap. And fair value gap is only effective below the 50% retracement level. So as you can see, the market retraces back to the 50% retrace, the Fibonacci level. And we will drop down to a lower time frame. Then we will drop down to a lower time frame. As you can see, as soon as the fair value gap hit, the market retraces back into the zone. And as you can see in this example, we won't be taking an entry, and if you do, you would have been stopped out. Let's move on to the next example. You go on to a 30 minutes chart, and let's look for another setup. One main rule I like to add is where it has to retrace back into the zone for it to be effective. If not, price often has a chance of going higher to the next level, or the previous highs, or the previous lows if you were looking on the opposite direction. As you can see, the highs have been taken here, and the market retraces back into the zone. Here, you'll be looking for displacement on the lower time frame below, and we have an order block here, and we would draw out this zone, we target. What we could do is we put a position on and put the stops above the order blocks, and we could target to the first low, but the ratio is not good, so we will not be taking entry like this, or the next low, which is 1:2.52. A good ratio is usually 1:2 or 1:3, or else you will not be taking a risk like that. Make sure to use higher time frame so you don't get stopped out more often, because the order blocks is less likely to respect on the lower time frame rather than the high. Okay, let's go over a recap on how you could use this on a chart and be profitable. So first, you go to the 30-minute time frame, or 15 minutes work, 45 minutes work, 1 hour, 2 hours, 3 hours, 4 hours. All these level above 15 minutes are effective to look for a important level to be taken. Then we look for a high or low that is being taken or is about to be taken. You do not want to see after the market goes into the high level, no sign of it going willing to go lower. And the candle closes above this level and shows no retracement back into the zone. So that's where you don't want to be taking an entry for a short. When market do this, it usually goes for the next liquidity level. As I could show you here, the market goes for this liquidity level, and if it does not show any sign of it retracing back, it will reach for the next liquidity level, which is on a higher time frame. Quick recap. I'll be on the 1 hour chart instead of the 30 minutes for now. Thanks for watching. Stay tuned for next video.